We're crossing now to our finance expert, Effie Zahos. Effie, great to have you with us this morning.
Good morning. Always great to be on the show.
Effie, we spoke a little bit earlier about interest rates potentially dropping below 1%. Now, I suppose the big question is, if the RBA does do that next week, will the banks be playing ball here and passing that cut on?
Yeah, interesting times. We've got to remember the big banks, they've got shareholders they've got to report to. So what they're looking at, ideally, they would love to charge homeowners the maximum amount and charge the least amount on their savings accounts. And that's what they're doing now. They're charging the least amount on their savings account. So that net interest margin, that profit they like to have is being squeezed. So look, there's an 80% chance on Tuesday that rates will move. And the big question is, how far will the big four banks go compared to the non-banks? Just to put this in perspective, so CanStar data has most people on a package loan with the big four are paying 4.08%. The cheapest in the market is 2.89%.
Oh.
It's a big gap, isn't it, Shelley?
Huge.
Huge. So the thing is here, it's pretty simple. If you are paying more than, I'm being really generous here, 4%, ideally 3% would be great, you're getting ripped off.
Okay, Effie, question. We know the big four banks and we hear about them all the time. There are a stack of non-banks out there that are obviously offering great rates, but how do you trust them and where do they come from? Where do they get their support from, their backing?
Yeah, so non-banks or non-ADIs, their market share is growing because obviously they don't have bricks and mortars. They get their money more from the wholesale market, so sometimes things can go in roundabouts. Right now, it is a lot cheaper for them to borrow, which is why we're seeing such great rates out there from non-banks. I say this, Shelley, to myself, I don't care who I owe money to. I'm more concerned about where my money is invested. And look, there's a lot of concern out there by home buyers. I don't know who these lenders are. The thing is, with loans, let's say worst case scenario, they go broke, more than likely your loan is going to be repackaged and sold on and you'll still have to pay it back. So you're not going to get off the hook there. It's important to look at these lenders because these are where all the cheapest ones are coming. And I suspect should rates move next week, then we're going to see the biggest movements are coming from non-ADIs.
Yeah, it's fascinating, Effie, and we know that a lot of people are taking them up on these low rates. But you mentioned before a little bit about savers as well, and this is going to affect first home buyers on the one hand, and then also the lower interest rates. I mean, what's that going to do to the first home buyer cohort, the prospective, the hopeful ones?
And this is the tight balance. I mean, obviously, the government wants us to jump into property. It stimulates the economy. It gets construction going and jobs. We want all that. But move it too fast and we could see that first-home buyers may be priced out of the market. When it comes to first-home buyers, there are two things from stopping them getting into the market. They can't afford their repayments, which clearly they can at such low rates, or they don't have that deposit. And if we do see prices jump up too fast, then unfortunately, first-home buyers are the ones that are really going to feel the pain there.
There's so much to think about, isn't there, when you're looking, and it's just balancing those scales. Effie, thank you so much for your fabulous insight. We will catch up with you very, very soon. We'll see you next time.